Thank you, Philip. I'd like to call to order the meeting of the Kentucky Retirement Systems Investment Committee for August 21st. And we will start with an opening legal statement.
Yes, sir. For the record, I want to note that this is the regular meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Sherry, would you please do the roll call?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins, Miss Bova,
Here.
and Miss Thompson. Thank you.
Thank you. Do we have a public comment?
And no, sir, no public comment today.
All right, thank you. And then we're not going to vote on it, but everyone has the minutes in their book, and we will circle back to those in our next meeting, I believe. There we go, the investment review and update. And as Ms. Bova, as a participant in the market, well knows, and I'm sort of in it. It's been a regaining volatility, to be kind, and so we'll let Steve go through the investment review and update on our on activities and performance.
Good morning. Thank you. I'm going to have Wilshire cover kind of the economic and market backdrop for the last quarter, give us a very brief overview. As Pruitt mentioned, lots of things have changed since June 30th. So from a historical perspective, closing out the fiscal year, what the market and economic conditions were, and then we'll jump into performance, portfolio, and outlook. So Wilshire?
Yeah, thanks, Steve. I'll kick it off starting on page 11 of the book. I want to talk about something that we've hit on in a number of these meetings over the last year or so, and that's the Fed funds rate. When are they going to start lowering rates after a very aggressive hiking cycle that kicked off to control the inflation that spiked in 2022 and generally the post-COVID period? So here we can see this chart was produced in early July, so you can see it runs through about July 10th. That the upper section has the Fed funds rate in black, showing that midpoint of 538. That's a range of 525 to 550 that they're targeting. And then in green, red, and blue, the June, September, and December implied rates. So based on market pricing, what the market was implying the expectation for the rate would be. And we see that early in the year, there was some aggressive pricing in of multiple cuts this year. The market was expecting about 6 cuts at the start of the year, and we can see that in the bottom chart here. This low point is between 6 and 7 cuts. And then over the course of the first quarter and into the early part of the second quarter, the market quickly adjusted to reflect a lower assumed number of cuts this year. And that held pretty constant in the second quarter, with the expectation being for 2.5 cuts by the end of the year. If we look at what has happened since the end of the quarter, targeting the rate target in December, the market's pricing in as of today using the CME FedWatch tool, about a 40% probability of a full 1% cut, and about 25% each for 75 and 125 basis points. So that center point of 100 basis points is kind of the expectation. There's an outside probability of a little under 5% of of a cut over 1.25% by the end of the year. So the market is now expecting closer to 3 or 4 cuts by the end of the year. So we have seen that bottom red graph ticking lower again since the end of the quarter. If we move forward to,
And I would just note that, you know, we do, and we've noted this, and I know Wilshire's noted this as well, that obviously the market expectation based on pricing changes day to day, right? And as we've seen the pull forward and the pushback on expectations, but we still believe there's a disconnect between obviously what the Fed is saying as far as the pace and magnitude of cuts, certainly over the balance of the year, and what the market is anticipating. I mean, we can even look towards the recent volatility, and you know, there were people calling for intra-meeting cuts, which we didn't think was very realistic. But you know, I think we'll probably get a little clarity at the end of this week at Jackson Hole. But it's still, I think the market is a little overly optimistic on expectations for the path of rates over the balance of the year.
Yeah, well said, Steve. Obviously, the market was well ahead of the Fed at the start of the year, kind of tempered their expectations and might be getting ahead of themselves again with the recent pricing action. If we move forward to the next page, just a reminder that the page 12, the Fed has a dual mandate. So they're trying to maximize employment while maintaining price stability. And the focus of the last couple of years has been that price stability part, as you can see here in the blue line, the core PCE and the inflation measure that they prefer to use really spiked and then has been on a steady decline. And the shaded portion shows their target Fed funds rate in the background. So aggressive hiking to try to get the price stability portion of this back under control. Meanwhile, the employment picture has been very has cooperated very much with them, allowed these rate cuts to happen without seeing much change in employment. But we have seen, you can see the trend in that red line of the unemployment rate. We have started to see a tick upwards in that, which signals that maybe the tide is turning in the employment picture. Very slowly, of course. At this point, we're coming off, I think we hit a 53-year low at some point in 23. So over 50-year low in unemployment. So it was expected that there wasn't much lower to go from, you know, the 3.4%, I think was the bottom in that rate. There's just a certain level of frictional unemployment that the economy is always going to have to expect. So if we move forward to page 14, that brings us to something known as the SOM rule, which has been a pretty accurate recession predictor in the past. You can see the red shaded portions here are recessions, and the rule essentially says that if the 3-month moving average for unemployment is 0.5% or more lower than whatever the low has been in the past year, that you've entered a recession. The problem with the predictive power of this rule is that, you know, now that we're coming off 50+ year lows, does that 0.5% rate still apply, or does it need a wider band? So again, we've seen that the yield curve has been inverted for some time, which is usually a pretty strong predictor of a recession. Now we see another indicator that's been a historically strong predictor, but with any of these rules of thumb, I guess you'd call them, you have to take into consideration the context that they're being applied against versus the historical norms. So some of these rules might not work quite as they have in the past, but again, another sign that the employment side of the equation for the Fed is just starting to crack a little bit, and something that we want to keep an eye on. And again, since, as Steve said, this is kind of focused on the second quarter, some of this is a bit old news at this point. I will stop there and hand it over to David to talk a bit about, you know, what we saw in some economic indicators in the markets.
I'm
Dave,
sorry, I was on mute.
Okay.
Thanks. Yeah, thanks, Craig. If we, Sherry, if we could go over to slide, I'll jump out to slide 18 for a minute. And we have a chart on the top that just shows GDP growth. And so just to sort of, you know, Craig was talking about rates and expectations and the Fed, et cetera. And just, you know, related to all of that is the story of growth. And that's been, that's been the whole thing that the Fed is trying to just get under control. And we look at GDP and thinking about, you know, when is it slowing, and then are we going to enter a recession? We'll see. But we look at GDP, and knowing that GDP is driven 70% or so by consumer spending, and consumer spending just continues to be strong. We are seeing some signs of weakness in that. I'll talk about that in a minute. But on this top chart, you see a 2.8% GDP number for that second quarter. And you can look back, we have 8 quarters in a row of positive GDP readings. Some of those were quite strong. 2.8% for second quarter. Estimates, you know, that we're seeing right now, it's still early in this third quarter, but estimates seem to be hovering around 2%. And so all of this is just, you know, just thinking about the growth and what is driving markets. It's been strong. Consumers continue to be strong, but there's really an interesting lag effect that I think that takes place with consumer spending, and that it will take a while it's taking a while, but it's starting to crack. As Craig said, it's starting to crack. It takes a while for consumers to really build up and be impacted by what has happened with price increases, high interest rates and everything. And so the rates have been having impact. That's the Fed's goal, that the rates have impact and slow things down. There has been some slowing in the whole mortgage market. Applications have slowed, refis have slowed. This has for quite some time really held down the inventory of existing homes that are up for sale, because most of those homeowners are somewhere around a 3% mortgage, and they're just not going to sell, even if they want to sell, even if they want to get a new house. So all of that has slowed. As rates begin to fall, when they do, that'll open back up. But that has really tightened that market. And then just looking at, you know, consumers are starting to feel the effect now, 2.5 years into this, where many components of goods and services are up over 20%, you know, cumulatively over these past couple of years. And so in most cases, incomes have not tracked with that. So there's a lag effect. It's starting to take place. And I think that is what, when you hear the Fed talking about, they've seen some different signs of softening data. It is happening. We're seeing inflation come down. The most recent year-over-year reading was right around 3%. So their inflation is getting back down there. You know, we've had, as Craig just pointed out, the unemployment stats and the slight slowing in job growth. These are the kinds of things that the Fed is looking for to be able to kick off those rate reductions. So we'll see. As Steve said, it'll be good to hear what they talk about this Friday in Jackson Hole. But overall, you know, I think there's some softening signs coming in, where those rate cuts will probably start to kick in at some point. All that said about growth, what Steve will review today is your performance over the past. If you just think about your fiscal year. In fact, I'll jump out to slide. Sherry, we could go to slide 22 for a minute, please. Your fiscal year, it's a strong year. Steve's going to report on that. You look back at June 30, you have a very strong 12-month return growth and compounding growth in terms of the fund's assets over that period. So you've benefited from this growth story that is happening in the market. And I'll just take this, one page 22 on the U.S. equity market. This being, our own equity market is probably the most followed market in the world. And it is certainly one of the significant asset classes in your portfolio. And so we just look at some of the components on this page. First of all, in that top left chart, if you go to the third column, the 1 year, we've had a lot of talk about the big tech stocks, the Magnificent Seven stocks that have been driving a lot of the market. And you see this when you look at in those 1 year numbers, the top line FT Wilshire 5000 index, 23.2% for the year. But if you break that down a bit, the two lines right below it, large caps are 24.8, and small cap stocks are about half of that. So you've probably all been just tracking this to some degree and seeing this in news and media, the impact of those large stocks that are driving a lot of this. It continues. We've had periods where it has broadened out a bit. A couple of weeks ago when we had this sell-off, personally, I was kind of happy to see the broadening out. You know, the large stocks were taking much more of a hit than a lot of the smaller company stocks, but it just hasn't been enough to see it in the trailing data. You still look here, look back at June 30 on 1 year, and you've got growth, US large growth up 35%. That's just taking the large stocks and now narrowing it down to the growth style component versus 14 for large values. So trailing periods continue to be strong, large caps outperforming small caps, growth outperforming value. And that's, you know, that's heavily driven by those big names. You have a broadly diversified portfolio, so there's a lot more going on in your portfolio and just what those large companies are doing, but they've had a lot of impact on returns for the U.S. equity market. So you'll hear more about that and just your results overall when Steve gets through that. So in fact, I'll just turn that over to you, Steve, right there after page 22.
That's perfect. Thank you. Appreciate that. Sherry, if you could go to page 35, please. And I will apologize in advance. I'm going to jump around a little bit when we were reviewing this material and how the order of what we wanted to discuss, and we're adding some new elements to the report. So we'll be jumping around a little bit, but as Wilshire covered, you know, it was very strong 12 months that ended June 30th, especially for U.S. public equities and mega cap growth stocks. So the portfolios closed out the fiscal year with positive performance in the final quarter. The KRS pension composite produced a return of 1.17 for the quarter compared to the benchmark return of 2.0%. While the KRS insurance returned 1.25 for the quarter versus a benchmark return of 2.40. Obviously, those are driven by different allocations. Drilling down into the portfolio level, the KERS pension portfolio returned 1.17 and the SPRS pension portfolio returned 1.06 versus a benchmark return of 1.92. The KERS hazardous pension portfolio returned 1.24 for the quarter. The KERS insurance portfolio returned 1.22. The KRS hazardous insurance portfolio returned 1.34, and the SPRS insurance portfolio returned 1.27 compared to a benchmark return of 2.40. Moving to the fiscal year, the KRS pension composite produced a return of 9.80 compared to the benchmark return of 10.51, while the KRS insurance composite returned 11.08 versus a benchmark return of 12.40. So across the board, strong performance for the fiscal year. We did trail the benchmark, which from an attribution standpoint, we'll get into a bit. At the portfolio level, the KRS pension returned 9.50 for the fiscal year. The SPRS pension portfolio returned 9.62 versus a benchmark of 10.11. The KRS hazardous pension returned 11.12. The KRS insurance portfolio returned 11.07. The KRS hazardous insurance portfolio returned 11.15, and the SPRS insurance portfolio returned 11.02 compared to a benchmark return of 12.40 for the fiscal year. The start of the new fiscal year, as David mentioned, was initially saw a significant pickup in market volatility, and that was really across markets, driven by both a barrage of economic data as well as elevated geopolitical risk and news, with a weak U.S. jobs report fueling recession fears among investors at the beginning of the fiscal year. Sell-off in U.S. technology stocks that David mentioned, which really had been the market leaders, initially led to a rotation from growth into value, with small caps significantly outperforming large caps. At the same time, the 10-year U.S. yield fell to its lowest level since February. That was on signs of cooling U.S. economic data and renewed expectation of U.S. rate cuts. For the month of July, U.S. and global equities were up modestly, while core fixed income outperformed on the back of falling yields. While the commodity index posted negative performance for the month, driven by a sharp drop in oil, real estate, infrastructure, and gold, all posted strong performance. More recent economic data, including the PPI and recent PPI and CPI prints, have bolstered confidence that the Fed's soft landing may be working, with recession fears subsiding, supporting a rebound in risk assets. And we've seen kind of an unwind of that rotation that we had seen early to start the fiscal year. While July performance is not yet finalized, the portfolios are off to a strong start in the new fiscal year and are indicated to be up about 2% for the month of July, outperforming the benchmark by 100 basis points. And as we'll get into a bit, notably, the public equity portfolio for the month of July outperformed and made up some of the ground that was lost during the quarter. Sherry, if you could move to page 40, please. Thank you. Following comments and questions at recent investment committee meetings and some follow-ups I had with individual committee members, we've included some additional detail that highlights the performance of the internally managed passive and proxy portfolios. And I would note that despite the recent elevated market volatility, these portfolios have performed in line with expectations, and really provide the portfolios with beta exposure to markets or serving as surrogates for asset classes where the portfolios are underweight. And so it provides that exposure as we look to deploy capital in new mandates or have capital that's already been committed called by existing managers. So this is an overview of all of the internal managed portfolios, the asset classes, proxy versus passive, and the performance versus the assigned benchmark for each portfolio. So I'll pause there if questions. This is obviously a new slide. But something that I think it was presented in obviously in prior investment committee meetings as part of the deck, but we pulled out from the manager report all of the internal portfolios to just highlight both again where we have proxies as well as where we have those passively internally managed portfolios.
Just
There's
real
no
quick, what is,
Sure.
sorry, what's the scientific beta?
Scientific beta. Joe will actually cover that in a few minutes when we talk about the attribution and performance of the public equity portfolio and kind of provide a bit of history on that. But it's a factor-based portfolio, and I'll have him provide some additional details. And that's it's been around since 2016. I believe Joe's on, but I believe that's the date when that portfolio was originally established. It's not a significant size, but it's U.S. equities.
So if you don't mind, I will talk about
Sure.
that when we get in the presentation, but just to answer her question more fully, this is a large cap factor-based portfolio. It plays in the lower portion of the large cap space, so it looks more mid cap like, and it has a value tilt. So I chose to bench it to the S&P 500 because we funded this allocation out of the internal S&P 500. It's not truly an appropriate benchmark from an exposure standpoint. If you were to benchmark it to the index that it actually tries to mimic, it's performed in line with that. However, because we funded it out of those dollars, I chose to bench it against this. And unfortunately, those factors it tries to exploit have not been rewarded by the market. And we'll talk about that when I get into the equity part of the presentation. But we're aware of its of the concern there. So we'll talk more about that here in a little bit.
Thanks, Joe. Sherry, could you go to page 58, please, if there's not any other questions on that page? Thank you. Across the portfolios for the quarter, the largest contributor to relative outperformance was the strong performance in the specialty credit allocation, which outperformed the benchmark by 122 basis points during the quarter. Within that asset allocation, 14 of the 17 portfolios outperformed the overall blended benchmark, so a very strong quarter, both on an absolute and relative basis for the specialty credit allocation. The most significant detractors of relative performance during the quarter were the public equity and private equity portfolios. While the public equity portfolio produced a return of 1.36% for the quarter, it trailed the benchmark by 149 basis points, driven by allocation and style biases that Joe will discuss in a minute. The private equity portfolio underperformed its stated benchmark by 11.09% during the quarter, with the underperformance attributable to the mismatch with the benchmark, which has been exacerbated in recent quarters. For the fiscal year, the core fixed income and specialty credit portfolios performed well, outpacing their benchmarks by 246 and 109 basis points respectively. The underweight to real estate, which was the only asset class with negative performance, also bolstered performance relative to the benchmark. The private equity portfolio's underperformance relative to its public market benchmark, which again is that Russell 3000 plus 3% lagged one quarter, was responsible for between 150 and 200 basis points of relative underperformance at the plan level, as the private equity portfolio underperformed this benchmark by over 28.5% for the year. The public equity portfolio produced a return of 17.01 for the year, but trailed the benchmark by 237 basis points as it failed to keep pace with the rally in the broader public equity markets, which were driven, as we talked about, significantly by a handful of mega cap technology stocks. And just to give a sense, if we look at for the KRS pension portfolio, so we're talking about on this private equity that Anthony's going to talk about the mismatch with the benchmark. We underperformed for the year that benchmark by 61 basis points. 150 of that was attributable to the relative underperformance of the private equity portfolio relative to that benchmark. So if we looked at performance X private equity, the portfolio would have been up about 90 to 100 basis points relative to the benchmark. So that really was the most significant driver of relative performance to that benchmark. So with that, Sherry, can you go to page 46, and I'll have Joe jump into the discussion on the public equity portfolio.
All right. Thanks, Steve. So we've kind of touched a little bit on markets already, so I won't spend much on this slide, but basically U.S. markets, as you've heard, very strong absolute performance demonstrated by the Russell 3, which is that blue bar there of about 23%. That's what we view to be the broad-based U.S. market. Growth outpaced value by nearly 20%. You see that in those green bars there. And then large caps roughly doubled, both mid and small caps. Those are represented in the gray bars. And the market was very narrow. You've heard mentioned it was driven by the mega cap tech names, primarily market concentrations at record levels. Historically, you will see a mean reversion there. However, large caps at the moment, very high valuations. Small caps are at a discount. Now those valuations are somewhat justified in that large caps have been the ones that are producing earnings. However, that earnings gap between large and small are forecasted to narrow in the next year or two. And so all that to say, we think there's a chance that this market should broaden out, which would be good for the portfolio as we are very diversified in the way our allocation is postured. Broadening would be helpful. Also, the active managers, it's very difficult for them, for instance, in the U.S., when the largest, basically 7 names drive the vast majority of market performance, and we have guidelines that restrict how much of those names they can actually hold, trying to force a diversification into our portfolio. So that creates headwinds in the portfolio from time to time. Internationally speaking, sorry.
Yeah, no, I'd say given the restrictions we place on the portfolios and
right,
the
so
limit,
one of our
the
growth
limited
managers. One of our growth
Yep.
managers aren't allowed to hold more than 5% in any one name. When Apple and Microsoft and Nvidia, and those are what drives the market, and they're 7-8% of their benchmark, they're automatically at a little bit of a disadvantage there. So not unreasonable for them to struggle a little bit in this kind of market. But moving on, international markets also solid performance, about 11.5% return. Emerging markets, which are signified by those green bars, outperformed their developed counterparts by about 1%. Large caps outpaced small caps by around 4%, and then value opposed to growth this time outperformed by anywhere from 3 to 4%, depending on developed or emerging markets. The market appreciation in the non-US space was kind of equal parts between multiple expansion and some earnings. However, correlations between earnings and stock price movements, especially in the non-US space, has been a lower end of what typically is there. And though improving, that creates a little bit of a headwind for active management. We employ a lot of active management on the international side, so that was a bit of a headwind there. If you don't mind sliding over one, Sherry, please. So this is kind of our performance as of the fiscal year. As you 17% absolute return is strong. Unfortunately, it's in the context of a 19.5% benchmark. And the US portion of our portfolio, we returned just under 22 versus 23. The non-US side, a hair under 10 versus 11.5. And relative performance in the aggregate, there were some issues within the context of individual mandates, but a portion of this underperformance is due to our slight international tilt that we had on in the early part of the fiscal year. It was a function of what we felt was more attractive in terms of valuations given the current market, and it's just not been rewarded. We have reduced that overweight slightly through rebalancing and a little bit of just the market performance itself, and recognizing the reality of what's working and what's not currently. If you look at that pie chart, that gives you the strategy mix that we employ in our global mandate. If you start at 12 o'clock and then move clockwise over to 7, those kind of blue shaded, that's our US mandates. Westfield, River Road, those are all cap mandates. Westfield Growth, River Road Value. Then there's the internal large cap S&P 5 portfolio that we fully replicate the index. That's the biggest piece of our strategy mix. Internal equity, you see there, that's the scientific beta that was brought up. It is a large cap mandate, again, factor based, maybe not the most appropriately benchmarked versus the S&P 5, but that's what I chose to bench it to, so I've got to live with that. Internal mid-cap portfolio, Northern Trust small cap, that's a quantitative core small cap portfolio, has been with us for 20 plus years. It's done well for us. Next Century is a microcap growth product that we brought in relatively recently. And then starting at BlackRock and moving all the way up to Pzena there, those are our international mandates. BlackRock's a developed passive strategy. We get market exposure relatively cheaply there. American Century through Franklin Templeton, Lazard, and LSV, those are AcquiX products. They invest in both developed and emerging markets. They all have their own bent. So American Century is an inflection point growth strategy. Franklin Templeton's more your traditional aggressive growth, a little bit smaller in cap. Lazard's relative value. LSV's a deep value contrarian play. And then Axiom's our international small cap manager. JP Morgan and Pzena are dedicated emerging markets, JP Morgan being growth and Pzena value. Sure, if you don't mind sliding to the next one. So what worked and didn't work within the US portion of our portfolio, if you look at the bottom left, we actually had pretty good performance across most of the mandates. 5 out of the 7 either met or exceeded their benchmarks. The 2 weak points being the internal large cap, which is that scientific beta, and then the Next Century microcap. If you go to the top right, this is an aggregation of the exposure of our US. So you'll see we're light large caps. If you recall from prior comments, large caps doubled up their mid cap and small cap counterparts. So that was a bit of a headwind. We do have more mid cap, some small and micro, and a little bit of cash in the portfolio. We are a little light growth, not necessarily heavy value, but we kind of anchor core. So we just don't have quite as much growth. And when growth outperforms the core markets by roughly 10%, that becomes a bit of a headwind from a style perspective as well. So there were some headwinds in the portfolio to try to overcome. Those really, if you go down to that bottom right, that came primarily in the form of the internal equity portfolio, which is that scientific beta. It, as you may have recalled me saying, it tilts more mid-cap feel and value-like. So if you look in the, I guess we'll call them those blue bars, that's our large cap exposure. And you'll notice we are significantly underweight the large cap market. Even though it is a large cap product, it plays very small. So Apple is, I don't know, 6.5% of the S&P 5. It's about 60 basis points in this portfolio. And so it just, with those mega caps running the way they did this year, it was a significant headwind for this strategy. Also, you'll see tends to favor not just the mid cap, but kind of more in that core to value play. So that was a style headwind for this particular strategy as well. So it was less about stock selection and more about allocation within the context of this particular portfolio. Next Century Microcap, smaller piece of the puzzle. It was down about 5% relative this year. We can get into examples if you want to, but basically it had lack of GLP-1 drug exposure. Healthcare is a big part of that sector, and because of that, it faced some headwinds. But it is stock selection driven for sure. I would note, since inception, since we've had them in the portfolio, they've returned annually a little over 20% versus a benchmark of 5%. So while this 12-month period was weak, overall relationship has been a 4x basically, and so not a real concern at this point with that portfolio. It just happened to land this fiscal year that they had some missteps. Sherry, if you'll move on one more slide. So non-US equity, this was again a lot about the way our exposures were. Essentially, you'll see 5 out of the 7 active managers underperformed, but the majority of them had the thing in common that they were growth biased. So American Century, Franklin Templeton, JP Morgan, those are the call outs. Those are the big underperformers. Axiom's a growth bias as well. They trailed a little bit. But really, these exposures that they have, they're just headwinds in this type of market. The market narrowness led to breakdowns and correlations and earnings and stock performance. And so you could find high quality companies that had good earnings at decent valuations, and they weren't necessarily, they just weren't rewarded in this market environment. So the one thing that kind of worked for us, our value managers for the most part did their jobs. If you look at LSV and Pzena in particular, they outperformed well. Lazard trailed a little bit. And so this was one of those, the basket of managers that complement one another historically have done a good job for us. This time, the underperformance of the growth just was not offset by the value guys. And I've kind of blown up the exposures there at the bottom. American Century, it was less about size and more about that style bias, that heavy growth, 23% more growth, a lot less value. If you recall, international markets value outperformed growth by over 4%. So there's a headwind there. Franklin Templeton, same style headwind when it comes to growth to value, even more so than American Century, but they were really plagued by that style bias, or excuse me, market cap bias, size bias as well. You see, they don't have a lot of large cap, 30% underweight. Heavy mid cap and small cap, and that was another thing where the large caps just outperformed by about 4% there. So they had 2 different exposure headwinds to deal with, but there was also for that portfolio some stock selection issues. They missed out on the GLP-1 trade altogether. They didn't have any exposure as well to Taiwan Semiconductor. That was a big winner in this 12-month period tied to that AI trade. They're the chip supplier to NVIDIA. NVIDIA had a heck of a year, and so did Taiwan Semi. They did have chip makers, but just not that one. So while theirs performed nowhere near to the degree that TSMC did. So they had, a few issues going for them this 12-month period. JP Morgan, that was less about size and more about style. Overweight growth, underweight value, same story as the other 2. They didn't have a lot of exposure to India. India was a really strong market in the emerging markets this year. They like the country from a long-term story, but tactically they're a little bit lighted at the moment due to valuations. There's the manager used the term nosebleed valuation, so they're just a little bit cautious of entry points at the moment, but they recognize that as a longer-term story. So I guess to put a bow on it, there were some stock selection issues within the portfolio this year. It's primarily an exposure and allocation issue. A lot of that is coming from the internal equity or the side beta portfolio. We're aware of it. It's disappointing to us. We're actually in the process of running a search to replace that mandate. We received RFIs as of close of business Friday, so we're beginning to read through those as potential options for that. On the international side, fairly happy with the way the portfolio's comprised, but there are some things that we need to pay close attention to and hopefully figure out some things there. So there's room for improvement. Steve mentioned July. July, we probably outperformed by about 60 basis points on the month. So that kind of dug us a little bit out of that hole. August, though, only 2-3 weeks in, all the strategies actually look really good through those first couple weeks of August. So first 6-7 weeks of this fiscal year look promising for us. Hopefully we can dig out of the hole that was created the last 12 months. So it's kind of a high level where we are. I'm happy to discuss further if anybody wants me to.
Hey, Joe, could I just add a comment about the markets that kind of gives a little context for this, and particularly in U.S. equity market? All the things that Joe talked about with psi beta and just the heavy driving of the market by these few names at the top. This is not an uncommon situation. This is impacting portfolios everywhere. If you look at trailing data on the U.S. equity market and just carve out that asset class, the index, the indexes, the S&P 500, the FT Wilshire 5000, they're ranking near the top. And that is just simply showing that no matter the attempt by most asset owners, there's some level of underperformance relative to those indexes because it's been so narrow. And I think, it's almost expected that investors would eventually not be, matching up to that heavy concentration of those few names at the top. So just for some broader context, it's all over the place.
Yeah, I would add that,
Appreciate that.
not just from an asset owner standpoint, when we try to build, and this part of this exercise was to provide about how we think about building the building blocks and building out that overall equity exposure. But it's been a tough market for asset owners who try to build diversified portfolios when it's such a concentrated market. I mean, we're talking about a handful of stocks contributing 70% of the performance to the overall index. So not just for asset owners, but for active managers too. It's a difficult market to outperform. Or, as David mentioned, that when the index is one of the top performers in a universe, that means a lot of active managers struggled to keep up or outperform, which is their mandate. But again, we're looking at a 12-month period here, as Joe mentioned. We review. Obviously, we're constantly reviewing the performance of managers and ensuring that they're doing what we hired them to do. They're sticking to the mandate, what we need. We think of them as complementary pieces in the portfolio, and hopefully that means when some are doing well, obviously not all are going to be doing well at the same time, but we'll have outperformers when we have underperformers. But we view these as how have they done over market cycles, certainly not over a month or a quarter, or necessarily even a year. It does, we have focus on where managers have underperformance and understanding why they underperformed. And as Joe mentioned, when we think about whether or not it's still an appropriate strategy for the portfolios, that's where we may evaluate that and consider doing an RFP and RFI to look for whether there's a better replacement for that risk budget and that capital. So appreciate that, Joe. I think that was a great presentation, and happy to answer any questions as well. If not, Sherry, could you go to page 50? Wilshire put together some slides, and Anthony put together some slides as well. And this is really more of a dive into that private equity, both the market, the benchmark, and our portfolio. And we wanted to highlight this given that it was such a significant driver of relative underperformance over the last 12 months, and kind of give you what the obviously we've talked about it for several investment committee meetings, the mismatch between the portfolio, and not just our portfolio, but the private equity market itself, and the benchmark that we have in the IPS. So I'll turn it over there to Anthony to cover these.
Hey, everybody. Yeah, the private equity, it can be difficult because I mean, obviously public equity is marked every day. Private equity, it's hard to know how well they're doing for many years. And so at a point in time for just like 1 year can is not super meaningful. But especially when the markets kind of seize up like they have the past couple years since the rate increases. So as you can see from here, this is just a very short time. So if we have 1.5%, which is nothing terrible, but the public equity markets rocketed higher first quarter and the first half of this year. So we're going to still probably see a lag for another quarter since the private equity numbers take some time to come in. So that's what this slide shows, is that even though the headline from Bloomberg, which is where the charts from the right, shows that it's still the biggest trailing of PE versus public markets over a year, in several years, but it doesn't really tell you a lot because all of our funds, the collection of them are, you're going to measure them over 8 to 10 years, not just one. So if you go to the next couple slides, or next slide 51. So yeah, this is a way that people do it. Right now we have the public index versus a premium. Obviously the pro is that it's, you can measure it pretty easily. But unlike the ideal benchmark, you can't actually invest in it. And if we could get index plus 3%, I think we would probably take that for some things, but that's just kind of a measuring stick to see how it is. The other thing is that also it assumes that you're fully invested all the time, and that's not how that works for private equity. We can make the commitments, and then the capital is drawn down over 2 to 3 years, sometimes 4. But obviously, usually general partners have a little bit of incentive to invest their capital. So, but it isn't always called, and especially as a lot of funds use credit lines, so that increases IRR for them, and that makes the numbers look good. It is not helpful for us, but unfortunately, some of our peers get paid on IRR numbers, even though you cannot eat that, as they famously say. So that's another issue with trying to measure the performance that way. So basically, we have had since I've been here, I think the index plus 3% benchmark, and when you look at that over a longer time frame, that is helpful. But over a year, when the market goes up 30%, your portfolio is just probably not going to keep up, even if the marks are going up, or even having some realizations. Even with the frozen market, we've had a few realizations from some of our managers, which you'll see in a couple pages, and those returns are good, just standalone, but they are not plus 30 in a year. So, okay, we can go to the next
Anthony,
slide.
Let me
Sure.
jump in for a second there. So this is, as we've talked about in the past, there's not an ideal solution, and there's certainly not necessarily an industry standard for how private equity is benchmarked in pension portfolios, or really in any portfolios. As Anthony highlighted, there's benefits and drawbacks to all forms. I will say at one point, the systems did use kind of a dual benchmarking system. And that was for short periods of time, which were considered 5 years and less. The performance used in the benchmark calculation was the actual performance of the portfolio, and for periods longer than 5 years, it was this public index plus a premium on a lagged basis, which is really more of an objective of a program. I think that ultimately, as Anthony mentioned, over the life cycle, which is going to be 8-10 years type of time frame, our expectations for why we would invest in this asset class would be the objective of achieving something of a public index plus that premium. That would be the objective that we want. One of the reasons that we've been light on private equity from a capital deployment is we have not seen that level of expected return from some of the portions of the markets that we look at. So we've been very cautious in deploying capital there. But again, there's no one size fits all solution. There's no certainly not anything broadly accepted across the industry. So it's something we might want to consider in our IPS. And again, this is only that what we currently have. There's certainly the potential, as we've seen over the last 12 to 18 months, of significant volatility or tracking error between the actual portfolio performance and what we're using as the benchmark for the asset class.
Could I just add that the use of benchmarking in the private equity is, as Steve and Anthony both expressed, is, I won't say weak. It's just, this is an absolute return asset class. And any relative valuations you make are dependent, or I mean, the comparisons are dependent on short-term pricing, which is spurious at best. And it just, you have to do it. I understand we need to do it to know where we are, but I don't put a lot of stock in the benchmarking process here. I think we've done as well as can be, but probably can fine tune that a little bit more, but as time goes on. But this is an absolute return asset class, end of story.
Yeah, and I think you'll see in the next couple of slides. So on 52, it just this slide basically speaks to how the relative performance can just swing wildly. So obviously, when markets are going up a lot, then the private equity markets just don't keep up, and then the same on the way down. So if you see on the kind of 2018 timeframe, the private equity markets held up, even though public equity markets were down. But that's with the financial crisis, because it's a 10-year return. But that's just so it isn't it's just a way to, it's just a data point, but it's not super actionable. I think like Period and Steve said, it's just something that you can kind of get a gauge, but you need other context to really make to help you make decisions. Okay, the next slide here, this shows cumulative over and underweighted performance. As you can see, like when the market was down in 22, the light blue line was very much above. And then, now with this last half of the year, it's way below. Again, that doesn't really tell you a whole lot in terms of whether our portfolio has been good or bad, especially when you have some long-lived assets that are still, in the calculation. All right, the next slide. So that last slide was 3 years. It says 10 years. Over a longer time frame, you can see that our portfolio, things that were done by our predecessors and us, have generally outperformed. If you go to slide 55, that this is something that Wilshire helped us help make send us, so you can see by vintage year the different funds that we have committed and how they've done over time. That's another way to do it, is to look at the vintages, because you can, your funds can only invest in the market environment that they have. So so this kind of discusses some of the relative performances by vintage. So the takeaway at the bottom is that it's outperformed over time broadly, though, if you take the portfolio as a whole. Page 56 is something that I made, and that it talks about a little bit of the idiosyncrasies of Kentucky. On the left side, the pension side, we did not invest in some of the private equity for a few of the underlying funds because of liquidity issues since 2010. That's also what drove a secondary sale, unfortunately. Right shortly after that, the pension side needed some liquidity, so we sold some of the exposures at a discount back in the several years ago. So that is why some of those plans don't have any of the exposure to the private equity growth that's happened over the long periods of time. And also why the pension private equity number tends to be lower than the insurance one, because they have a lot less of the exposures. And the insurance one, the same thing, only the KRS plan didn't really invest for several years. But at this point, they all are, given that liquidity has improved for our plans. So going forward, they are all getting some portion of it. And another thing to note at the bottom is, given that these are very long-term assets, most of these assets, almost a majority, definitely a majority of the pension and almost a majority of the insurance assets are over 10 years old. So they just aren't growing as much as perhaps newly deployed capital. And so that's another reason for sometimes not keeping up in a quickly rising public equity market. And finally, for page 57, you can see this is specific to this to the period that we're talking about now. Again, 1 year is really kind of too short to look at anything, but yes, there's some funds here. I think on the pension side, you can see The top three are fund of funds, and all of those are quite old. I think they're all pre 2009 or before. So Horsley Bridge is a venture fund of funds. So some of those companies obviously have continued to have some markdowns. And then I think generally private equity as a whole has, because just things are not as transacting, and with interest rates up, obviously the terminal value and future cash flows also decrease in value. So that's explains some of those. I would say that some of the ones beneath that, three through 6, are some of the newer funds, and they've held up in it for the 1 year period, because some of those have had exits and or dividend payments, and or write-ups to some of their assets. So those have held in. I mean, stood by itself, 11, 12, 20% is pretty good, but it does not keep up with 32. So that's part of that. On the insurance side, similar story. I think what you can look on, the highest one is Kane Anderson. That's an oil and gas upstream fund. It had some issues investing in the mid 2010s, but the remaining assets are performing and producing, and so the uplift in that area, results in a high 1 year number. But that explains why it's -8 still over 5 years. So unfortunately, that is the long-term performance of that fund, because things were bought at high valuations in the mid 2010s. But so hopefully that can explain some of this, the underlying. But yeah, 1 year is essentially too short to kind of look at private equity. But we have to show performance. So we can obviously provide more detail if anyone ever has questions, and go through this in more detail. But generally, it's obviously something we keep track of in great detail. We compare funds, basically to what they're trying to do, and but it's not just a data only evaluation, right? We're evaluating their process and team and changes like that, whether they have some deals that are working or not. And so that's kind of more of evaluation than just strictly a quantitative one, I would say. So I'm happy to take any questions if y'all have any, or going to Steve here.
No, thank you, Anthony. I appreciate that. And I think you also did a good job of highlighting, and I wanted to emphasize that, in alternative asset classes, and probably especially in private equity, that vintage year really matters. We've talked about that a lot, and the diversification of vintage year, which, so not only are we seeing the dispersion at the composite level, and the underperformance relative to that benchmark, given kind of the mismatch, but at the individual portfolio level, we're seeing dispersion in the performance of the individual private equity portfolios, given where they're allocated, when they participated and when they didn't participate, which is driving some difference in performance within the same portfolios that may have the same target allocation. So I just want you to appreciate that, just because we have a 6% target for two different portfolios, now those portfolios may not have participated in the same vintage year for the liquidity or other reasons. So and we see the variability in that vintage year performance across managers. I mean, there's obviously some managers have done better given their strategy for certain vintages, but that can have a big impact on individual portfolio private equity allocation performance.
That's right. Oh, and one more thing I forgot to add was, just even a year and a half ago, for end of 2022, I went back. I forgot to put this. I might do it for the C one. The exact opposite conversation was happening. So for the insurance side, the 1 year return for private equity was 6.5, and the benchmark was -15. So it's just wild swings. It doesn't really mean a lot, but it's just that's what can happen when things are one thing is marked every day and other things are not. So.
I'll pause there are there any questions for Anthony or I? If not, Sherry, we can go to page 70, please. Try to quickly hit the highlights of the rest of the presentation here. Page 70, again, this is Wilshire's slide, one of my favorite slides that we show. And just to highlight that while the portfolio has performed well in absolute terms, as we've discussed, as expected, given their lower overall risk profiles and lower allocation generally to public equities, they underperform from a broad peer perspective in a year where U.S. public equities, especially large cap growth stocks, significantly outperformed. However, all of the portfolios have continued to deliver top decile or top quartile risk-adjusted returns over 3 and 5 year periods, which really demonstrates the efficiency of their construction and the underlying management. Page 82, please, Sherry. Thank you. We have continued to opportunistically rebalance the portfolios towards the revised IPS asset allocation targets that were effective in February. As of the end of the fiscal year, the positioning of all asset classes for each portfolio were within the IPS specified range, with the majority of the positioning within 1.5% of the target allocation. The largest overweights in the portfolios of between 2.1 and 3.3% were in public equities, which was largely driven by the outperformance of the asset class. The largest underweights were in real return and specialty credits, where we anticipate capital already committed to be called over the balance of the year. We've also maintained a modest underweight to private equity target allocation, as we've discussed, as we've seen limited value in the asset class from a relative basis, with better opportunities in other asset classes. I would say that we have, however, begun to focus more on the asset classes recent underperformance and the funding difficulties that Anthony highlighted have created a more attractive potential landscape. Across the pension and insurance trust, $300 million of committed capital was called during the quarter, primarily in real return and specialty credit. So we're ramping up those exposures quickly, and we expect that to continue over the balance of the calendar year. And that's especially important as those managers are finding compelling investment opportunities, which will benefit the systems. Also, during the quarter, staff executed a total of $350 million of rebalancing trades, which were primarily focused on de-risking the portfolios and again moving them towards the revised IPS targets. Page 98. This is an easy one this quarter, so I like this. As of the end of the fiscal year, there were no issues to report that were not in compliance. And I also am excited to report that Mike Lamb and I have begun the first round of interviews for the compliance officer position, which we hope to have filled by the end of September. So hopefully some enhancements to the reporting function as we move forward. Page 123. Thank you. We ended the fiscal year well below budget, having spent only 71% of the amount budgeted for the entire fiscal year. The consulting and contractual services categories were in line with the amount budgeted, while legal and auditing services came in well below the amount budgeted for the entire fiscal year, with only 45% of the amount budgeted spent. I would also note the significant variance at the individual service provider level, as noted in the percentage of amount budgeted column. As we know, these legal expenses can be difficult to predict and are often driven by activity outside of KPPA's control. We also included the recently approved investment budget for fiscal year 2025. Overall, the budget has increased by $2.3 million or 23%. While most of the categories and individual line items only increase modestly based on expected contractual inflation adjustments, the amount budgeted for legal services was increased by $1.9 million or 38%, and that's based on discussions with the legal group in anticipation of increased costs associated with ongoing litigation, as well as the exhaustion of the trustee and officer litigation insurance policy. We've also budgeted, I would note, in that consulting services category for an additional private markets consultant, which would be a complement to our existing services. And that's something that we're looking at potentially bringing on board. So we had added a line item if we were to do that over the course of the fiscal year. Page 126, please. Thank you. For the full fiscal year, investment fees and expenses were $34.7 million more than fiscal 2023, but $28 million less than in 2022 and in line with fiscal 2021. As the table highlights, there's significant volatility as to the composition of the total fees and expenses over time, with the largest drivers being the performance fees and the miscellaneous fees and expenses categories. Focusing just on that investment advisory fee line, which is the base fees that the systems pay to external investment managers, I would note the consistency across time, with only a 13% increase in fees since 2021. despite a 20% increase in total assets. Staff continuously evaluates and negotiates management fees to ensure the effective fee rates paid by the systems are low by institutional standards for assets of our size and strategies. Just to highlight, the core fixed income investment advisory fee is less than, all in is less than 7 basis points. Public equity is around 16, specialty credit 53, real estate 77, and private equity is 47. As the table shows, that volatility in performance-based fees across asset classes, and that's especially evident in the alternative asset classes, which are more heavily skewed towards variable performance-based fees. For fiscal 2024, specialty credit performance fees were up 17 million as the portfolio produced a return of nearly 12%, which was 500 basis points better than in 2023 and 10.5% better than in 2022. Private equity performance fees also increased as the portfolio produced a 3.8% return for the year, rebounding from negative performance in fiscal year 2023. Alternatively, performance fees for real estate have continued to decline as the portfolio produced a negative 9.9% for the year, following a negative 2.7% return in 2023. We've also seen a sharp rise, as we talked about in the last several investment committees, in the miscellaneous expense category. And that's for strategies that rely on credit facilities, and that's really driven by the significant rise in front-end rates that we've seen. Specialty credit saw an increase of 12 million, and real estate saw an increase of 3 million. And I would note that these credit facilities are usually a key component of the investment strategies where they're being deployed. And that's the portfolios, the investments in the portfolios earn a spread above that base rate, which is LIBOR or now SOFR. So despite the cost of these facilities increasing as rates have risen from the zero bound, the portfolios have benefited by earning more on those investments that they're funding. The last thing I would highlight would be the reduction in core fixed income advisory fees. And for the fiscal year, that was a reduction of 350,000. And that's despite a 25% increase in the market value, which was driven by rebalancing of the portfolio, including bringing a sleeve of those assets in-house, which ultimately, as we've noted before, we expect to reduce fees by between $1.5 and $2 million per year. So I will stop there and answer any questions.
Anyone have any questions or thoughts? Well, I will make a few at the risk of looking at this portfolio's year. I'm looking at the fiscal year specifically from a high altitude level. I'm first of all impressed with and pleased with the digging into the weeds that the staff has done to understand the various underperformance areas. But I'm also pleased that in the big picture, we did do 17% roughly across the board. And never apologies are not necessary when we have that kind of absolute returns. But this is a very good education, and if you will, and some of the things that have happened. And in the last year or two, I was actually around during the Nifty 50, and none of you all are old enough to remember. Maybe John Chilton is, the Nifty 50, and I saw an interesting study. And what the Nifty 50 was a comparison of the big seven or whatever, the dominant, and it was the Nifty 50 was a huge number of the S&P, but I think 13 of those companies went out of business. So you have to when you see a performance outperformance or dominating companies, it's probably some lessons to be learned from history there. Sears Roebuck was, by the way, one of the Nifty 50. Boy, they're a powerhouse growth company, aren't they? So you didn't make much money in that one. And IBM was the largest, I believe, in the Nifty 50. They haven't done terribly well. But anyhow, I think there's some good lessons there. But I think it was a good year, and I do appreciate the analysis, digging into it, and also hammers home that some of these classes that we invest in are just difficult to measure, other than the absolute return. And I've made that comment about during Anthony's presentation. If we're making good money in excess of our expected returns, then we did well. So, any other comments anyone has? If not, well, thank you for your time and attendance, and you know, we had a couple of members not here. You know, I'll reach out to them and see if they have any questions they want to address to the staff from the book, and that said, I will adjourn this meeting.
Thank you very much.
Thanks, everyone.